My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach, put in context. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, how do we make sense of this seesaw of a market that got slammed earlier today, then rebounded in the afternoon?
House of pleasure.
Closing down 80 points, S&P losing 0.24%, NASDAQ falling 0.58%. I think what we're seeing here is nothing more than a wholesale repricing of stocks, as investors collectively try to bake in all sorts of contradictory possibilities. The repricing ebbs and flows, and you see intraday rallies as people realize that businesses are actually pretty good, and the stock market remains the best place to put your money. That's what happens when stocks fall. If only because every other asset class is so unattractive does this occur. It's not because this one's that beautiful. Still, I think we have more pain like we experienced this morning, which is why you need to understand what's driving it. So when the pain happens, you're not paralyzed, because we're going to see it again and again. First, there's a whole camp of people who believes that our economy is headed into a recession, probably sooner rather than later. How do I know this? Because at the worst moments of today's session, when the averages were getting hammered and it looked like, well, the whole thing was going to collapse, buyers started standing up in the recession stocks. Think Kimberly-Clark, Procter & Gamble. But these are not the kinds of leaders you want to see. They're just exactly the kind of stocks that do well in a slowdown. Later, the strength spread to Adobe, Estee Lauder, not to mention MasterCard, Visa, Nike, among a host of other stocks. What do all of these companies have in common? They're not really dependent on the health of the global economy to make their numbers. Domestic, yes. Global, no. They can make the numbers. Second, there's another camp of investors who are trying to game out the election. Oh, boy. Specifically, this group wants to price in the possibility of an Elizabeth Warren presidency. Now, Warren has started to edge out Joe Biden, and she's no fan of certain industries, especially the managed care ones. You know, I could have done another. There's some... Stick with me on this, because... Let me just I'll deal with the managed care in a second, but it's really rather extraordinary how bad they are. See, for instance, today something happened that I haven't seen in a long time. There was an analyst, and as he came out, a good analyst, and said that he had for the first time in 20 years, he had a buying opportunity, the best he'd seen, Cigna. Okay? I read the piece. I said, how much is Cigna going to be up? This is just it is going to be so good. But then I realized, if Warren's the front runner, you don't want any exposure to the health insurance space. So what happened? This stock got hammered rather than rallying. Best pick in 20 years. Best pick in 20 years, and look what it does. What can I say? I guess you picked the wrong day to recommend Cigna. It closed down $5.43. If Warren can really pass something like Medicare for all, a very big if, then the managed care companies, you know what? This is going to cease to exist. I find that to be unbelievable and not true, but that's what people are thinking. So then why the heck did I tell people of the ActionAlertsPlus.com club that they ought to buy United Health, my favorite of the managed care plays? Well, okay, there's the fact, first, I've never seen it cheaper. Then there's the fact that it now actually supports a roughly 2% yield. I've seen that in ages. Then there's the fact that UNH is about as oversold as any stock I can recall, down more than 70 points from its highs. Mostly, though, we don't even know if Senator Warren's going to get the nomination yet, let alone win the presidency. And even if she does win, that doesn't mean she'll have the votes to pass single payer. I think it's too soon to count out UNH. It's too soon to write off Cigna. I think that's wrong. These companies are queening money. Still, that doesn't change the fact that Wall Street is terrified of a Warren presidency, and you can see that fear everywhere. Ever since Warren started pulling away from the pack, I mean, you know, she's now viewed as a putative leader. Very good article about her being in the front today. Well, we're seeing aggressive selling in the market's biggest winners. And hear what I'm talking about? Twilio. We had Jeff Lawson on last night. Amazon. Cramer Family Fave. Okta. Why? Because if you own these stocks, you know what you have? You have huge gains. And you know what Warren wants to do? She wants to tax those gains. Tax those gains at higher prices than you currently have to pay. Now, again, this is just one possible outcome. The people who own these stocks, they want to ring the register now, just in case Elizabeth Warren raises the capital gains rate to the same as the ordinary income rate. Between the recession fears and the need to price in the possibility of a Warren White House, I think we could get more swoons like we had this very morning. But hopefully the sellers will exhaust themselves like they did this afternoon. Still, as long as Senator Warren is leading the polls, you're going to keep seeing winners being sold, and they're going to be really sloppy days. And you're going to be asking me on Twitter, Jim, what's wrong with this thing or that thing? And it won't be Micron, which had a quarter that disappointed. It'll be something that's doing really well, like Twilio. And the answer is people taking profits. The third thing that gives the bears cover, impeachment. Now, I'm not a political commentator. I never will be. But the hearings on Ukraine today, I thought they were pretty brutal, frankly. Suddenly, serious people in the media are talking about Trump like he's toast. I think that's crazy. The votes just aren't there to convict him in the Senate, no matter what he may have done. Still, that won't stop the bears from using the story as a cudgel to beat the stock market lower. It's going to be the narrative. Get used to it. Personally, I'm less interested in the political ramifications. What matters to me is what impeachment means to the legislative agenda. Remember, we just spoke to Speaker Nancy Pelosi last week, and she was sounding very encouraging about the possibility of passing an updated trade agreement with Mexico, Canada, something many businesses I know are counting on to make their earnings estimates for 2020. But I don't know. A week later, maybe it's not going to happen. I don't see it happening. How is Pelosi going to negotiate with a guy she's trying to remove from office? Maybe it's possible. Doesn't it seem unlikely to you? Oh, and of course, if the Chinese smell blood, they're a lot less likely to try to make a trade deal with Trump. They'll wait him out. Of course, they don't know who Senator Warren is, believe me. Now, if the Chinese leadership is reading the same newspapers we're reading, they'll probably be emboldened to wait this president out with the hope that they'll get somewhat more accommodating in 2020. The final piece of the repricing puzzle of why stock prices, the price-to-earnings multiple of what we'll pay for earnings is going down. The IPO market is starting to fall apart. Listen, bankers. Listen, syndicate desk. Your market's falling apart. I've been predicting this was going to happen all year. I'm surprised it took to September. I thought it was going to happen in August. We've been overwhelmed by the supply of new deals. It's crushing the market, which is why the latest IPOs have been so ugly. First, there was that Smile Direct fiasco, which priced at $23, then closed down 28%. First day, 28%. Smile Direct has kept getting hammered. It's now less than $13. Then there was that clown show of a WeWork deal, which got postponed because of horrendous corporate governance issues that cost the CEO his job. The SEC should have demanded that, by the way. And today, Peloton. Yes, the sports bra hanger for my wife, priced at $29 and started trading at $27. That's right, opened at $27. Why not? It's exactly the kind of stock that this market no longer is interested in. And I'll give you more on that later. It finished at $25.76. And yes, she does also put some of those nice Lululemon pants on it, too. It's not just the Nike sports bra, so I don't want to get to the wrong image. Thank you. When you look back at the biggest deals of this IPO cycle, like Lyft and Uber, they are now down so substantially from where they came public that they burn your eyes out. Put it all together. And I can understand why people were eager to sell this morning. Between a possible recession, impeachment, and, of course, an ascension of Democratic candidates perceived as hostile to big business because Biden's going down in the polls, Warren going up. Well, you got a lot to worry about. Now, I think that the fears are overblown. But on days like today, at least you know, these are what's driving things lower. This is a repricing of the stock market because of these four things. Remember, when President Clinton got impeached, that ultimately turned out to be a fabulous buying opportunity. I think the Fed is too savvy to let a recession happen. And even if Elizabeth Warren wins the nomination in the general election, she won't have the votes in the Senate to go full FDR on us. But the IPO spigot, oh, that is the real thing. Until we turn off these deals, just say no to these deals. There's not enough money coming in to soak up the new supply. The bottom line, as long as investors have trouble understanding that President Trump won't be removed from office by a Republican Senate and Elizabeth Warren isn't some Marxist insurgent out to destroy capitalism, we could have more difficult days like this one. Maybe lots of them. Get used to it. Toussaint in North Carolina. Toussaint.
Toussaint? Yes.
Yeah.
How formidable is Roku as a streaming competitor against Apple, Google, and Amazon. And is Roku a good investment at these levels?
Roku has gone up too far too fast, and it's now in a downtrend. While I like the company, people got carried away as a way to be able to play cord cutting. I want to let it cool off, and I want to see it bottom first. I know, Toussaint, that is not necessarily what you want to hear. I would love to call the bottom on Roku, but that to me is a license to kill my reputation. Let's go to Joe in New York. Joe.
Hey, Jim. Long-time listener, first-time caller. I own United Technologies, UTX, in my 401k. How should I approach the upcoming company split?
With pleasure, because that company is run by Greg Hayes. He's no nonsense. The company's putting together. The company's splitting. They're both going to be great. We would own them instead of Honeywell. We have Honeywell for the Charitable Trust. You can follow along by joining the ActionAlertsPlus.com club. The only company that I think can hold a candle industrially to Honeywell is UTX. Stay with it. Nice going. Boy, I wish I could recommend that Roku. I like it. But, you know, when these stocks break, well, it's tough to call the bottom. Look at Micron. We don't know yet. Have to do the conference call. All right, now listen. It's not going to be easy to figure out how to price in a recession. I mean, an impeachment. Prospects of Warren presidency, IPO market. This is an erratic market, and it's an emotional market, and you got to steel yourself and get used to it and strap yourself to the mast. On Mad Money tonight, Herman Miller and Steelcase are sitting pretty after earnings. But can the rise in both companies continue? I'm going to give you my take. And how much of Peloton's moves today were just spin? I'll tell you if it could be a smooth ride going forward for investors. Plus, take it to the house. I'll check the foundation of the home builders with one of the leading players in the space. May I suggest that you stick with Cramer?
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.